Okay, so let's talk about tax for small businesses in South Africa. I know. For a new entrepreneur, it can feel like trying to solve a puzzle in the dark. It seems complicated, the rules can feel a bit confusing, and you're worried that one wrong move could cost you. But honestly, it doesn't have to be that scary. We're going to flip on the lights and give you a clear, straightforward guide to get you started.
So you've done it. You've got that amazing idea, you've got the drive, and you're ready to build something that's all yours. That's awesome. But along with all that excitement comes a whole new world of responsibilities. And let's be real, one of the biggest is getting your head around tax right from the very beginning.
I want you to think of this as your roadmap. We're just going to walk through the big decisions and the must-dos one step at a time. The goal here is to turn that feeling of confusion into confidence. All right, let's get into it.
Right. Your very first stop on this journey is deciding what your business actually is, legally speaking. And this is so much more than just paperwork. It's a choice that has a huge impact on your personal risk, how much admin you'll have, and of course, how you're going to be taxed.
Okay, so this is your first big strategic choice. On one hand, you've got a sole proprietor. That's the simplest way to go. You and the business are exactly the same thing. Easy, right? Well, the catch is you have unlimited personal liability. If the business gets into debt, your personal stuff, your house, your car, it's all on the line. Tax-wise, every cent of profit the business makes just gets added to your personal income, which can easily push you into a much higher tax bracket, maybe paying up to 45%. Now, on the other hand, we have the private company. This creates a legal wall between you and the business. It's its own person. The company pays its own tax at a flat rate. Right now, that's 27%. That's predictable, and it could be a whole lot lower than what you'd pay personally. Yeah, there's a bit more admin involved, but that protection and the potential tax savings, it's a massive difference.
So, once you've picked your business structure, it's time to go introduce yourself to the South African Revenue Service, or as we all know them, SARS. This part is absolutely non-negotiable, and it's where we need to nail down a really basic but super important tax concept. And here it is, your first big deadline. You have 21 business days from the day you start trading to get registered with SARS. When you do, you'll get your tax number, and that number is basically your business's ID for everything tax-related from here on out. Now, listen up, because this is a point that trips up so many new business owners. The net profit that you see on your financial statements is not the number SARS uses to calculate your tax bill. Think of it this way. Accounting rules and tax rules are like two different languages. You start with your accounting profit, but then you have to make a few specific adjustments to translate it into what SARS calls taxable income, and that final number is the only one they care about. Getting this translation right is the absolute key to making sure you pay the correct amount of tax, not a cent more, not a cent less.
All right, so you're registered, you understand the difference between profit and taxable income. What's next? Well, now we have to deal with the three main types of tax that pretty much every business in South Africa will come across.
First up, the big one, income tax. This is the main tax your business pays on that taxable income we just figured out. And as you've already seen, this is where your choice of business structure really matters. If you're a sole proprietor, that income flows right onto your personal tax return and gets taxed at those sliding personal rates. If you're a company, the company itself pays the tax at that flat corporate rate. So the key thing to remember is that the legal structure determines who pays the tax and how much they pay.
Next is VAT. Now this one is totally different. It's not a tax on your profit at all. Honestly, the best way to think about it is that you've just become a tax collector for SARS and you're not getting paid for it. You add 15% to your price, you collect it from your customers, and then you pay it over to SARS later. But here's the critical thing you have to understand. It's all about cash flow. That VAT money might sit in your bank account for a couple of months, but it is never, ever your money. Managing that cash carefully is absolutely vital.
And then there's the moment you hire your very first employee. Congratulations! You've also just taken on a new job, tax administrator. This is called employees tax, or PAYE. Every month you have to figure out the right amount of tax to deduct from their salary, and you pay it directly to SARS for them. Here's the kicker. It's their tax, but it is your legal responsibility to get it right. If you mess it up, the penalties land on you, the employer. So this is one of those things you have to nail every single month.
Okay, when it comes to VAT, this is the number you need to burn into your brain. 1 million rand. If your total sales, and I mean sales, not profit, if your sales cross that 1 million rand mark in any 12-month period, you have to register for VAT. It's not optional. But here's an interesting little strategy. You can actually choose to register long before you hit that million. Now, why on earth would you do that? Well, if you have big startup expenses like buying computers or equipment, registering early means you can claim back to 15% VAT you paid on all that stuff. It's a smart move that can really help your cash flow right at the beginning.
Okay, now we get to the fun part of the journey, the part where smart moves can actually save you money. Understanding what you can legally deduct from your income is the most powerful tool you have for managing your tax bill. But it's also where a lot of people make easy mistakes.
So the law gives us this powerful tool with a very formal name, the General Deduction Formula. But the idea behind it is incredibly simple. Ready? If you spent money in order to make money, you can usually deduct that expense. See? It's not about finding sneaky loopholes. It's about knowing the single most important rule of the game for legally lowering your taxable income and, by doing that, lowering your final tax bill.
And this slide just shows that rule in action perfectly. Let me give you the secret phrase that SARS lives and breathes by. Expenses have to be in the production of income. So claiming a wear and tear allowance for your work computer? Of course, that computer helps you produce income. But what about the cost of your groceries for home? Nope, that's a private expense, not deductible. If you just apply that simple test to every single expense, you'll be on the right track.
We're almost at the end of our beginner's journey, but this last part is all about the long run. Staying on the right side of SARS isn't about being scared. It's just about building a few good habits from day one. Let's call them the golden rules.
So don't think of this as a list of chores. Think of it as your compliance toolkit. First, your records are your proof. You have to keep every invoice and receipt for 5 years. It's your only defense in an audit, and it's how you claim every single deduction you're entitled to. Second, deadlines are not suggestions. Submitting your returns and paying on time is how you avoid nasty penalties and interest. Third, just keep SARS updated. If you move your office, let them know. It's a small thing for you, but it's a big deal for them. And finally, if you are a VAT vendor, your invoices need to be perfect. They're official tax documents. Seriously, mastering these 4 habits is the foundation for a stress-free relationship with the taxman.
And there you have it. That's our roadmap. We've gone from choosing your business's identity to understanding your main duties to mastering the rules of the game. Once you understand not just what the rules are, but why they exist, you stop just following them. You start making smart, strategic business decisions. So the real question isn't just are you ready, it's how are you going to use this knowledge to build a smarter, stronger business from the get-go.